Hi everyone. I want to take an opportunity to work on two more problems with you in this screencast, just to go over two more concepts from Chapter 2. The first is problem 2.17. 2.17 can be found on page 83 of your textbook, Understanding Financial Statements, 11th edition, Lynn M. Fraser, Eileen Ormiston. I'll just briefly read what the problem states. It says the Lazio Ranch just purchased equipment costing $60,000. The equipment is expected to last 5 years and have no salvage value. They want you to calculate the depreciation expense using the straight line method for the first 2 years the equipment is owned. Calculate the depreciation expense using the double declining balance method for the first 2 years the equipment is owned. So they want you to calculate using two different methods. We learned that accounts receivable contains a management estimate called the allowance for doubtful accounts. We also learned that inventory on the balance sheet is valued based on a management decision, namely the method used: first in, first out, last in, first out, and average cost. Now we examine the long-term assets, property, plant, and equipment. While the initial cost of these assets is pretty straightforward, the cost is based on invoiced amounts that are paid by check or an electronic equivalent. However, these assets are used up over time in the activities that generate revenue. As we learned about accrual accounting, we need to match expenses with revenues. We do that using a method that amortizes costs over time, or in other words, spreads the costs out over a period of time. For plant, property, and equipment, we call this depreciation because it represents a using up or a depreciation of the asset over some useful life. The methods management can choose from include the straight line method, units of production method, or some variation of an accelerated method. Management makes these decisions and they become the policy for expensing plant, property, and equipment. Under the cash basis system, you would simply record the amount of the purchased equipment in the period when it was actually purchased, the full amount of the piece of equipment, against whatever cash was received during that period. In the accrual method, we're going to record only a portion of that purchase cost in each of the periods that it benefits. So in each period that that piece of equipment is used, until it is fully expensed, we will recognize a certain amount of it as expense within the period. The information that you need to solve a problem like this is 1, the original cost, 2, an estimate of useful life, and 3, an estimated salvage value. Finally, you need to know which method management uses. So in the problem at hand, our equipment cost is $60,000. So that's the invoiced and paid cost for this equipment. The useful life estimate, and this is usually based on some schedule that management puts together, is 5 years. In this case, they estimate the salvage value at 0. So sometimes there can actually be an amount listed there as salvage value. It depends again on management's judgment. Now, using the straight line method, all you really need to do is divide the equipment cost minus any salvage value by the estimated useful life in years. And what you'll end up with is 60,000 divided by 5, which gives you $12,000 per year. And so the depreciation expense for year 1 is $12,000. The depreciation expense for year 2 is $12,000. The accumulated depreciation account, because remember, depreciation expense is on the income statement. Accumulated depreciation is a contra asset account that shows up on the balance sheet and allows you to report your plant, property, and equipment net of its associated accumulated depreciation. So at the end of year one, the accumulated depreciation equals $12,000, the same as the depreciation expense. At the end of year two, the depreciation expense for that year is $12,000, but now the accumulated depreciation account is going to have $24,000 recorded in it. So that the value of those assets after year one, or the book value of those assets after year one, would end up being $60,000 minus $12,000, or $48,000. At the end of year two, the book value of those assets is going to be $60,000 minus $24,000, which would be $36,000. Okay, so hopefully you see that. Straight line is pretty easy to put together. It's not that difficult. Now, when we look at the double declining balance method, this is an accelerated method for depreciating assets, which means it's going to depreciate assets faster earlier in its life and slower or less depreciation later in the asset's life. And how we accomplish that using the double declining balance method is double declining balance means 2 times the straight line rate. And so in this case, what is the straight line rate? Well, we're depreciating over 5 years. And so we depreciate $12,000 per year. And so when we depreciate $12,000 per year, that's equivalent to 20% of the asset each year. If that's the straight line rate, if 20% is the straight line rate, then the double declining balance rate would be 40%. And so in year one, we have the equipment cost of $60,000 times 0.4, or 40%. And so depreciation expense in year one under double declining balance is going to be $24,000. When you move to year two, unlike straight line depreciation, under double declining balance, you have to subtract from the original cost the previous year's depreciation expense. So it would be $60,000 minus the $24,000, or $36,000, times 0.4, or 40%. And so the second year's depreciation expense would be $14,400. So over 2 years using the straight line method, you end up depreciating the asset by $24,000. Using the double declining balance method, the same asset is depreciated $38,400. So you can see that under the double declining balance method, more depreciation is taken out in the first 2 years than under the straight line method. This will reverse as you move forward through years 3, 4, and 5. Under the double declining balance method, the amount of depreciation expense will continue to fall below the straight line method all the way down to whatever the salvage value happens to be. It's important to understand how these work, the different depreciation methods, because when you're looking at the financial statements, you want to be able to make an assessment about what's being shown on the face of the financial statements as their net property, plant, equipment. It's important to know which depreciation method they're using so you could understand how this equipment is being expensed over time. How quickly is it being used up? Because again, the link between the balance sheet and the income statement with this particular problem is that depreciation expense shows up on the income statement, whereas the accumulated amount of depreciation shows up on the balance sheet as a contra asset account that is netted against the gross amount of the equipment costs. And so you constantly are adjusting the book value of the equipment down from its original cost over time as it is used up. Now, again, this is all a management estimate. It does not necessarily reflect the actual life of a piece of equipment. There are plenty of pieces of equipment in use today that have been depreciated fully for years and years and are still being used to generate revenue for a firm. This is an accounting convention that we use under accrual accounting to assign costs as expenses to particular periods of time. And what we want to do is we want to match the costs or the expenses to the revenues that they were responsible for creating or generating. So hopefully you guys picked that up. Next problem that we're going to take a look at here is problem 220 here, 2.20. And 2.20 starts at the bottom of page 83 and continues over onto page 84 in your text. This particular problem, the requirement is that you write an explanation discussing debt structure, include in the explanation why the debt structure is considered risky, and include an explanation of the information that's contained or appears in the financial statements directly against information that's not directly appearing on the financial statements. And so what we had, and this is a writing skills problem. Now, I'm not going to write a memo here, but I am going to kind of go over what's important to note here. So what I've done is I've taken the information from the text and created this Excel spreadsheet. And so the information that was originally provided included the current liabilities, long-term debt, other liabilities, and total assets amount here. And then this schedule of operating leases and capital lease payments. I added the rest of this. I created the balance sheet, at least the total assets, total liabilities, and total equity. I did that because we know what total assets are. We add these three items up to come up with what the total liabilities happen to be. And using the accounting equation, we can figure out what total equity is. And of course, it works out to balance. So I think we have it correct. Again, that's something you can do. The problem isn't specifically asking you to do that, but I think it's a useful mechanism to help you understand the problem. Now, some of the things that I did, when we talk about debt structure refers to the duration and timing of principal and interest payments on loans that the company takes out. Debt structure, the term structure refers to the attributes or characteristics of the debt, such as maturity dates, principal repayment terms, provisions for repaying loans, covenants and restrictions that are included in the loan agreements. It implies a classification framework that we can use for sorting or organizing a firm's debt so that we can report it and analyze it. Now, debt structure can be assessed along a continuum of riskiness. So some debt structures are more risky than other debt structures. Typically, the more debt a firm takes on, the riskier the debt structure becomes. The main issue with ShopWorld's debt structure is the use of operating leases. The way accounting works right now, operating leases versus capital leases. Capital leases, we record a liability. So the amount that's actually owed is recorded on the books as a liability, and there's a current portion due of the capital lease and a long-term portion due for the capital lease. Operating leases do not get recorded on the balance sheet. Operating leases are simply expensed as rent is paid. So in other words, if you have an operating lease that has renewal periods that extend beyond the current year, it's an off-balance sheet form of financing. So it ends up being invisible to somebody who is just reading the face of the balance sheet and just doesn't see any debt associated with the rent payments that are showing up as expense on the income statement. And as you can see, ShopWorld by far they have many more operating leases than they have capital leases. So, and I calculated a times ratio for this. The amount of operating leases is 43.04 times the amount of capital leases on their books. And so this represents a significant off-balance sheet financing source for this company. So that when you initially calculate, say, a debt-to-asset ratio, which would indicate the proportion of their assets that are being funded by debt, it works out to 61% using the information that's in the balance sheet. However, when I revise it to include the amount of the operating leases in existence, it changes or increases from 61% to 74%. This increases the riskiness of the debt structure for Shop World. So the fact that they're using operating leases hides some of the what could be considered long-term debt by an analyst or by an investor. It hides it from the balance sheet. It buries it in the notes to the financial statements so that when they calculate ratios, the ratios may look more favorable to them. The debt to equity without making the adjustment is 1.59. By revising it to include the operating leases, the revised debt to equity is now 1.93. That's a significant increase. And so this increases the riskiness of an investment or increased riskiness of loaning this company money. And so that's kind of important to take into account. So again, when you would write up a letter or a memo to somebody explaining this, you'd want to organize your answer around the key items identified in the problem. So at first, they want you to explain the debt structure of the company. And in this case, what you would focus on is that, one, they're using a significant number of operating leases as opposed to capital leases, which means that the long-term portions or the long-term effects of these operating leases are not recorded on the balance sheet, that they only show up as rent expense or operating lease payments in the income statement on the expense side. So that's going to be important to note. They also want you to address the riskiness of the debt structure. And so when you're going to address that, you could say that, well, these hidden liabilities that are not readily apparent or readily appearing on the face of the balance sheet increase the riskiness of the firm because it increases the debt to assets ratio by 13 percentage points, and it also increases the debt to equity ratio from 1.59 to 1.93. And then finally, they want to talk about the explanation for the information contained on the face of the financial statements versus that which isn't. Well, we've kind of been alluding to that. You can kind of summarize it by saying that the use of operating leases essentially removes what could be considered long-term debt from the balance sheet and hides it in the notes to the financial statements and records it as just rent expense in the income statement. So it turns a long-term liability into a periodic expense. And so therefore it could be seen as being a little misleading. There have been efforts to change this in the accounting profession through the FASB and the IASB. I think to this point they have not been successful. I would have to do more reading up on it, which I'll be doing some reading up on this as I go into next year to kind of check on the status of this, because I'll be teaching Intermediate Accounting 1 and 2 this fall and spring. But for the time being, this is the general rule that they follow. And so operating leases provide an opportunity for companies to move some liabilities off of the balance sheet and kind of hide them in the notes to the financial statements. So hopefully this kind of gives you a clear picture. This is two more areas. We looked at plant, property, and equipment and the use of depreciation methods that help us to record the using up of long-term assets over time to generate revenue and how that impacts both the income statement and the balance sheet. And we also take a look here at the impact of different types of financing arrangements, operating leases versus capital leases, and the impact that those have on both the income statement and the balance sheet. And so these are all things that need to be considered when you're analyzing financial statements.